15 minutes to talk about gold mines. It's going to be pretty easy. I will focus on the main message today, and the main message is that 2021, 2022 is not 2013 and 2015. And when I refer to 2013, 2015, I'm actually talking about this. Between 2013 and 2015, gold went down by 20% and gold mines fell by 50%. And the reason why I'm talking about this period of time is because a lot of investors are thinking that we are in the same environment than when we were in 2013-15. And the whole point of this presentation is to convince you that we are not. The environment is completely different. As a matter of fact, we think that we are in the middle of this gold bull market, so there is still a lot of potential for upside, and I hope that you will be convinced by the end of those 15 minutes. Quickly, very quickly, production has peaked 2 years ago, and we don't expect something significant on this front. On the demand side, basically what you should just focus on is the fact that jewelry is picking back again from the COVID recession, and the only really key factor in that demand structure are the ETFs, the speculative demand. So if we annualize the numbers, that the official numbers of the World Gold Council, we are negative 200 tons in 2021. But if you annualize last quarter, we would be down 80 tons only. And if you want to look at a bigger picture, we do believe that the selling that we faced over the last 3 quarters is going to respond to that environment I was referring to earlier in my presentation. So, in a nutshell, what is happening today? Today, most of the institutional investors, hedge funds, they think that tapering, and they are right, is coming. We are in an environment where we came out of the recession. We had outstanding growth in 2020-21, and that growth is going to continue. That's number one. And the growth continuing and tapering being starting would impact positively the rates in an environment where the Federal Reserve is telling you that inflation is transitory. So tapering, growth, higher rates, lower inflation ultimately means higher real rates. And when you know that real rates has the highest negative correlation with the price of gold, you understand their reasoning. And what we are saying is that yes, we do have growth, but the growth is decelerating. That's number one. We're also saying that on the inflation front, and I will show you a few slides later, well, maybe inflation is more sticky than transitory. So I'm not playing with the words, but it's going to impact meaningfully the price of gold. And finally, we cannot compare the 2013-15 period with today on the deficit front or on the debt front, because the environment is so different. So bottom line, we're saying that rates might continue going up, but we have reached a tipping point. So the 10-year, US 10-year, we always said that, and people were laughing at us, we always said that, and that was 6 months ago, that we have a tipping point around 150, 160% on the 10-year. And we did go above it, but for a short period of time, and we came back. But our point, our position here is to say we are at the tipping point on the nominal rates in the US. Debts are exploding, deficits are increasing, we'll show you this in a second, and inflation is sticky. That means, fundamentally speaking, that means stable or lower real rates, that's positive for gold. And number two, with those macro numbers so dire, this means ultimately a lower US dollar. And we know that the US dollar has the second highest negative correlation with the price of gold. So lower rates, lower US currency, this is what we believe is ahead of us. So we're going to go through a few slides about inflation, about debt, about deficits. That's the inflation that is being published by the Federal Reserve of Atlanta. They have they have tons of measures for inflation, but these two are very pertinent. They have what they call the flexible inflation CPI, and they have the sticky CPI. So we should focus on the sticky CPI, which basically turns around 2.5, 2.6, 2.7%, which shows you that there is some inflation. I mean, you're not discovering this. There is inflation, but it has nothing to do with that flexible inflation that everybody is talking about, and about this hyperinflation environment in which we might end up living. So we don't believe in hyperinflation. All what we are saying is that we have a sticky inflation, and this sticky inflation might not be just transitory, but will last a little longer. Second slide about inflation again. This one are the numbers published by the Federal Reserve of Cleveland. And this time we're not focusing only on the CPI, but on the PCE. PCE being the most favorite measure of inflation by the Federal Reserve, the American Federal Reserve. So what we should focus on here is about the median PCE, and that median PCE is still going up. So yes, the trend is towards higher inflation, but we are not in an environment where we can reasonably believe that the probability of hyperinflation are real. So inflation is sticky, it will last, but it's nowhere close to hyperinflation, and definitely not the scenario of deflation is nowhere near our environment. When we're talking about deceleration in growth, this is the measure of the Fed of Atlanta that measures the GDP, the American GDP, and that was for Q3. And all you have to see is over not the weeks but the days, they kept reviewing downward their growth expectations. So we did have north of 6% growth rate, US GDP growth rate, but this rate, based on any projection, is going to decline. So we are not saying that we're going to move to a recession in the next couple of years. All we are saying is that we had so massive fiscal stimulus, so much monetary liquidity entering the system, that it pushed our growth rate at levels that are unsustainable. So the reality is that from north of 6%, we're going to move to probably 3%, and ultimately long term we'll go back to our 2% average growth rate. So that means that rates cannot and will not go higher. And now a few words about deficits. The Congressional Budget Office told you that in 2021 we'll have the second largest nominal deficit in the history of the United States. And this is not getting better over time. This is not. Second figure, the deficit and the debt relative to the GDP. For those who won't have a very, very long-term horizon, that's the forecast again of the Congressional Budget Office is a 200 debt over GDP in 2050. Let's not go that far. All we care about is what's going to happen in the next few years, and this slide is showing you that things are not going to get better. So, back to our two criteria to measure where gold is going. And I'm sure that Ross will follow me on this. Real rates and US currency. Real rates, this is the slide that you have here that shows in yellow gold and in white real rates. When real rates go down, gold goes up. All you have to know is to have a conviction about where real rates are going. And I hope that you understood that those real rates cannot go much higher up because there is no risk of deflation in an environment where growth is slowing down. Second picture, the US currency. Deficits, debt, we just mentioned them. How could those deficits increase? How could this debt increase without affecting the currency, the national currency? So we do believe strongly that the US currency is going to weaken. In a nutshell, people are telling you tapering, that will push rates higher. Now, let's see what history is telling us. History is telling us that each time QE ended, Q1, Q2, QE3, rates went down. Rates don't go up when QE ends. They go up, they go down. So remember this. Anybody who is telling you tapering is coming in the summer, that's what the Federal Reserve is telling us. This summer, 2022, we will end tapering. If this summer 2022 tapering ends, rates will go down. They are not going up. And the reason is very simple. Less monetary help will impact growth. Slower growth doesn't go with higher rates. Lower rates, they are telling you that we are heading into an environment where we'll have slower growth, which we already know. So this is not rocket science what I'm telling you, but there are very few people who will tell you that at the end of each QE, rates are going down. Now, my favorite slide, and you should look at this graph. So for those of you who are not familiar with the Wilshire 5000, basically it's the US economy. That's what it is. All the publicly listed companies in the US. So basically it's the best picture you can have of how investors are valuing the economy of the United States. And this is our ratio of Wilshire over gold mines. And here we were at the end of 2015. Here we were in 2018. And this is where we are today. Here, gold mines went up by 100%. That was the beginning of the bull cycle for gold. Here, gold mines went up by 100%. That was our second leg up in that bull cycle. And this is where we stand now. So just think about everything I told you about growth, about inflation, about how rates behave in a post-tapering environment, and maybe you will be convinced that the next direction for this ratio is down. In that case, you should be invested in gold mines. And finally, last slide to remind you, that's a 35-year graph. To remind you, and it's the ratio of the gold mines over the price of gold. I'm not going to bore you with the multiples of NPVs, of cash flow, of earnings. Just remember that these gold mines are still historically undervalued. And it's not because they went up by 185% now, that it means this is the end of the bull cycle. We truly believe that the upside from here is significant, and if you want to ask me where these gold mines are heading, I will tell you they will do exactly what they did in 2015 and 18, which is probably and hopefully outperform the generic equity benchmarks, but probably double from the present levels. How much time do we have left?
2 minutes. 2 minutes.
2 minutes. So this concludes my presentation, and I'd rather have the audience ask me questions rather than emphasize a few other points on the presentation.